Hello students, in today's class I'm going to introduce you to the concepts of hire purchase accounts by looking at number 1, the meaning of hire purchase agreements, number 2, common terms of hire purchase, number 3, the differences between hire purchase and credit sales, and lastly the calculation of hire purchase interest. So let's get started. All right, let's look at the meaning of hire purchase. So before I give you the definition of hire purchase, let us consider this scenario. Let's consider this scenario. Let's take, for example, one Mr. S, okay, is a seller who decide to sell his property or goods, say motor van. All right, just follow this scenario. He decides to sell his property or goods, say motor van, to Mr. say B, who is the buyer. That's the buyer. All right, then Mr. B agrees to pay, to make a periodical installments, okay. He agrees to make periodical installments, periodical in the sense that, let's, for example, yearly basis. On a yearly basis he will be making payments on installmental basis, okay, payments of fixed, take note, of fixed amount, Take for example, say 50,000 naira every year, periodical installments to Mr. S. All right, let's take for example the full price until the full price is completed. Now look at the full price. Let's say the full price is 300,000 naira. All right, 300,000 naira. That's the full price of the motor car. So Mr. B agrees to be making a periodical installments payment of say 50,000 to Mr. S. All right, until the full price is completed. So before the full price is completed, take note, the ownership on the motor van still remains with the seller, with Mr. S, which means that Mr. B, okay, Mr. B only possesses the goods. So the possession on the goods is just with Mr. B. He cannot resell. Mr. B cannot resell this motor van, okay, because the ownership on the motor van is still with the seller until full price. Take note of that, until full price is completed, okay. Now then, another thing about this arrangement is this: anytime Mr. B fails or defaults in his payments or fail to make the periodical payments, okay, the periodical payments, Mr. S has the rights to withdraw the motor van or to withdraw the goods from Mr. B. Anytime Mr. B fails to make the periodical installment, what Mr. S will do is to withdraw back the motor van. That is one. Secondly, all the previous installments will be forfeited. Mr. B will lose the previous installments. So that is one thing about this arrangement, and this arrangement is called the hire purchase agreement. So this is what we call the hire purchase agreement. All right, so the ownership on this motor van will be transferred to Mr. B after the full price take note, write it down, after the full price had been made by Mr. B. Okay, that is when the ownership. So once the ownership has been transferred, Mr. B can decide to resell the motor van. Okay, can decide to sell the motor van. All right, can do anything with the motor van. But before the full price is completed, Mr. B doesn't have the right to resell, because the motor van does not belong to him. It still belongs with Mr. S. So this is what we call hire purchase. Okay, so what is hire purchase? Write it down. Hire purchase agreement is a system of buying under which properties or goods are acquired with payments made in installments. With payments made in installments. With payments made in installments. Okay? So I will repeat. Hire purchase agreements can be defined as a system of buying. A system, underline that, of buying, under which properties or goods are acquired with payments made in installments. With payments made in installments. So this system of buying will enable the customer to enjoy the goods. It will enable Mr. B to enjoy the goods even though he has not finished paying. So you only enjoy the goods because the goods will be under the possession of the buyer. All right, so that is hire purchase agreements. All right. All right, now let's look at the common terms of hire purchase. Number one, cash price. Cash price. So what is cash price? It's nothing but the normal selling price. The price at which a product is to be sold. That is the selling price. So it's the normal selling price. That's what we call the cash price. All right, take note of that. Then we have hire purchase price, HPP. Hire purchase price is nothing but the cash price plus hire purchase interest. Hire purchase interest. Take note of that. That is what we call the hire purchase price. Is the summation of the cash price and the hire purchase interest. All right. Then the next one is hire purchase interest. Hire purchase interest is also known as finance charge. Finance charge, okay? Finance charge. Take notes. And what is hire purchase interest? Is nothing but the excess of the hire purchase. The excess of the hire purchase price over the cash price. Over the cash price. Over the cash price, okay? All right. Now, initial deposit, this is another term, is the amount, write it down, is the amount payable by the hire purchase buyer at the beginning of the hire purchase transaction. Let's take, for example, the cash price, say, is 200,000. Then in January, I'm to pay installments by December. Installments is to be paid by December, okay? All right, but the buyer decided and said, okay, out of this 200,000, let me pay first. Let me pay 100,000. That's the initial deposit. So it will be subtracted. So it's the amount that is paid at the beginning of the hire purchase transaction. So we have a balance of 100,000. So it is this balance now that will be paid on installmental basis. Okay, so what we call installments. Installment, therefore, is the amount that is paid to reduce the balance of hire purchase price after initial deposit had been made. Okay, after the initial deposit had been made. All right, so that's what we call installments. And this installment, take note, will be part of the balance, just part of this balance, part of the balance of the outstanding balance, okay, plus the hire purchase interests. because the higher purchase interest is normally calculated on the outstanding balance. The higher purchase will be calculated on the outstanding balance. Okay, take notes. So we are going to demonstrate that later. I'm going to show you later how to calculate the higher purchase interest. But take note, it is normally calculated on the outstanding balance. So the installments contains part of the balance and higher purchase interest. And this is the amount, is the sum that is payable to reduce at, it is normally paid at a specific period or specific interval to reduce or to liquidate the balance of the higher purchase price, after which the initial deposits had been made or not. So what we are going to pay by December, by the end of every period. So it depends on the agreement, right? Okay. So let's continue. So let's look at the difference between higher purchase and credit sales. We are all familiar with credit sales. Okay. Higher purchase is guided. The law that guides higher purchase agreements is called the Higher Purchase Act of 1972. Okay, while the law that guides credit sales is nothing but the Sale of Goods Acts, Sales of Goods Act 1930. All right. In higher purchase, ownership is not transferred immediately. Write it down. Ownership on the goods is not transferred immediately to the buyer. But in credit sales, ownership is transferred to the buyer. All right. I'll repeat. In case of higher purchase, ownership on goods is not transferred to the buyer immediately. But in case of credit sales, ownership on goods is transferred to the buyer, okay, immediately. It's transferred to the buyer immediately. Once the agreement has been made, the ownership will be transferred. All right. Then, in case of higher purchase, payment is made in installments. Payment is made in installments. Okay. But in case of credit sales, payments is made in lump sum. You just pay once, or you just decide to pay twice, and that's all. Or sometimes you pay at once. That's cash sales. Okay. Or you pay at a specified future date, which is credit sales. So payment could be credit or cash sales. The sales could be credit or cash, but for higher purchase, the system is different. It's paid on instrumental basis. Okay. In higher purchase, interest is added. Interest is added to the cash price. Take note, in higher purchase, write it down, interest is added to the cash price. But for credit sales, no interest is added. No interest is added to the cash price. Are you with me? All right. Now, in higher purchase, if the buyer fails to pay the installments, he will forfeit. He will forfeit the previous installment, and at the same time, the goods will be withdrawn from him. All right, in higher purchase, but it is not so in credit sales. Can you see the difference? So that's one of the disadvantages of higher purchase. Students should take note of that. In higher purchase, once the buyer fails to pay the installments for a particular period, the seller has the right to withdraw the goods, then he will now forfeit what he has been paying from the beginning of the contract. But it is not so in credit sales. All right. So I want you to give me the difference to re-explain. Just write the difference, replay the video again. Write the difference between hire purchase and credit sales, okay? And submit on the Prodigy. All right. So lastly for today, let's look at the calculation of hire purchase interest. The calculation of hire purchase interest. Let me give you a format. So to do that, you have your details, then the workings, okay? Then, if, for example, for year 1, if you are calculating for year 1, okay, at the beginning, let's say January, you will have your cash price. Students should take note of that. Then by that January, you will less initial deposits. Take notes. You less the initial deposits, okay? Then you have a figure. Then by December of year 1, by December, you will compute your hire purchase interests at a certain percentage, okay? That is on the balance, on this balance. Then you will subtract, you will add, that is add, you add the hire purchase interest, sorry for that, you add, okay, you add, or you subtract the initial deposits, you add, then you have a balance here. All right. Then by that same year, December, we have our installments. You will subtract, okay. Then you have balance carry forward, okay. Then come to the next, that's year 2, the second year. So in this case, in the second year, there will be no initial deposits. You just go by the December. So by December, by the end of the period, it could be any month. I'm just using December. It could be any month. Depends on when the contract starts, okay? So we have the hire purchase interest at a certain percentage. It could be 10% on the balance. Take notes. You will add. All right. Then we have installments. So you reduce by that December, you have your installments. So this will continue for the rest of the year under consideration, okay. Then the last installment, then if it is last installment, this will be nil. All right, supposing that is the last installment, supposing this is the last installment, this will be nil, or you continue for third year and so on. So let's take a practice question. Let me just give you, let's bring a practice question and use it. Now let's look at this simple analysis. Given that cash price is 220,000, initial deposit is 61,500, then the annual installments is 50,000, payable for how many years? 4 years. Then the hire purchase interest rate is 10%. Okay, so let us calculate the hire purchase interest for that 4 years. What will be the hire purchase interest for the 4 years? So what you will do, the first thing, like I always said, you write what you are about to do. That is calculation of hire purchase interest. of higher purchase interest. Okay, then you have your details, take notes, then the workings. Students should take note of that. Okay, all right, then for the first year, that is year one, year one. Okay, so by the beginning of the year, let's say January, let me use the word January so that you understand very well. We have our cash price. So what is the cash price? The cash price in this question is 220,000. So you have your 220,000. Okay, then you will less by that January the initial deposits. So what's the initial deposit? 61,505. Put it in brackets, and this will give you, let's pick up our calculator. So you have your 22,000 minus 61,505. Okay, and it will give you 158,455. So this will give you 158,455. Okay, 495. Sorry, 495. All right. So then that's by December of year one. Okay, by December 31st, okay, 31st, we calculate the higher purchase interest will be calculated at 10%. So what is 10%? 10% of this. So this figure now, you just multiply by 0.1. Okay, 0.1. All right, that's 10%. It will give you approximate 15850. All right, class. That is approximation. You approximate this. Okay, 50. Then it will be added. So let us add. Let's add plus 158 495. All right. So when you add this, you are going to have 174 3 4 and 5. Okay, then that same December 31st, you will subtract the installments of 50,000. Subtract installments of 50,000. So once you subtract the installments, so this is addition, don't forget, you have 1 2 4 3 4 5. So this is our balance carry forward for year one. Okay, now for year two, in January, okay, there is nothing in January, so we have the initial deposit has been paid in year one. So you start with December. Okay, 31st, you will calculate higher purchase interests at 10%. All right, so what is 10% of this? So let's calculate 10% of this. We have 1 2 4 3 4 5 times 0.1, that is 1 2 4 3 5. Okay, so you will add, take note, you will add this. So once you add this, what do you have? 1 2 4 3 1 2 4 3 4 5 plus 1 2 4 1 2 4 3 5. Okay, so I'm having 1 3 6 7 80. Okay, then you will, that December, the second year, you will subtract the installments for that December, installments of 50,000. Okay, then if you subtract, you have 86780. All right, so if you use your calculator, then this will give you the balance carry forward. Then year 3, so we have our year 3. By December, we'll calculate our higher purchase interest. All right, so you calculate the higher purchase interest at 10%. So this will give you 8678. That's 10% of this. All right, from your calculator you add. So once you add this, what do you have? You have a plus, that is it will give you 95458. Okay, then don't forget your installments will be deducted. Installments, so of 50,000 will be deducted. So we have 45458. Okay, class. All right, now for the last year, the last year is year 4. By December, you calculate what? Higher purchase interest at 10%. So what's 10% of this? That's 4. Okay, you now, before you do that, we know for the last year, we know that we cannot pay more than 50,000. So you first write your 50,000. So look at that. I'm going to do the last year. You cannot pay more than 50,000 because the installment, look at this installment. That December, the installments must be 50,000. All right, which is nil. All right, now what will be the higher purchase interest for the last year? Now what will you do? You will say 50,000 minus 45458 to get your last interest. All right, because you cannot pay more than 50,000. So what you will do, you will say, look at 50,000 minus 45458. So let's do that. That is 50,000 minus 45458. I think I'm having 4542. So this will be 4542 because of the approximations. So that is how to calculate. So this is minus, it will give you nil, which is the last year. So this is how to calculate the last. Don't forget the last, because you first write the installments. So you will remove the balance from the installments, okay, to ascertain the interest for that year. All right, take note of that. I told you, I said installment is part of the balance and higher purchase interest. Take note. That's installment for you. The balance installments, okay. Any installment you are paying part of the balance and the higher purchase interest. Any installment paid is part of the balance and higher purchase interest. You understand now? Okay, so that is for that. So this concept is in finance. Are you with me? It's in finance. So if you understand the finance aspects very well, okay, so that is higher purchase. So we have been able to look at the scenario of higher purchase. That's the meaning of higher purchase, the terms used in higher purchase, then the difference between higher purchase and sales of goods. And lastly, ability to calculate higher purchase interest. So your assignment is on the Prodigy. Write the difference between higher purchase and credit sales. What's the difference between higher purchase and credit sales? Write the difference. Write 4 differences. All right. I'll be expecting your question. I remain Mr. Shesi George, your account teacher. Always remember to remain safe. Bye.